So with that, I'd like to introduce one of the managing partners and founder of Metrics Credit, Andrew Lockhart. Please welcome Andrew.
Thanks, Mark. Thanks, buddy. Thanks, mate. Thank you, everyone. For those that have not had any exposure or experience to Metrics, a brief introduction. Metrics Credit Partners was a business that was established back in 2013 when we launched our first fund. So myself and my three other partners launched the business back in June of 13 with one single financial product for investors, providing investors with exposure to private market loan assets. Since then, the business has grown substantially. We have now well excess of 60 people in the business with premises and offices in Sydney, Melbourne, and now in Auckland. Our business is very much focused around direct origination and the risk management associated with directly lending to companies. As Mark mentioned there, the four key markets that we cover are loans to both private and publicly listed corporates. We're active as a financier to project and infrastructure related borrowers, commercial real estate, both development financing for private developers and also real estate investment trusts. You'll see here a range of logos that cover those three areas, and another key part of our market that we access is loans to private equity sponsored operating companies. So as a business now, since June of 13, we've completed in excess of 8 billion of transactions, over 300 individual transactions across a range of both investment grade and sub-investment grade exposures. So we've seen substantial growth, and it's been pleasing the support that we've been able to gain from investors as we've built our business. I think it's interesting when we talk about income and generating income from asset classes. It's interesting that often, there are a couple of things that people always say about fixed income, or the yields are unattractive or low, or that it's difficult to gain exposure to a diversified portfolio, or the risk is asymmetric. As a private lender, I would say a lot of those things are incorrect. So from our perspective as a lender, our skill set is about going out, building relationships with companies, seeking to develop those relationships and originate transactions for the benefit of our investors. If you think about it in the context of a market, you've got public market securities investors, say an equity investor or a bond investor, that is generally a passive buy-side investor. You think about the equity manager, they haven't been involved in bringing the IPO to market. Or if you're a bond manager, you've tended not to originate the transaction. You've bought the bond based on a price and a credit rating that's been delivered to you through an intermediary. In our business, we're private markets operators where the skill set requires you to go out and hunt and find those opportunities to lend to companies. And so across our spectrum, we believe that when we look at the universe of the companies that we lend to, you can find opportunities where the risk and the return relationship changes. And as a result of being an unregulated lender, a non-bank lender, I guess we have the fortunate benefit, of also having a range of options that are available to us in circumstances where credit quality might deteriorate. So if you think about in circumstances where credit quality might deteriorate, you need a manager that's going to roll up their sleeves, go through the workout process, go have the experience to do a corporate restructure to protect and preserve investor capital to the downside risk of loss. So when I look at this asset class, you look at the particular areas where you sit, and the income that can be generated from corporate loans is very appealing, considering where you also sit in the capital structure. Obviously, other asset classes will expose investors to greater volatility of capital, so the stability of their capital might be impacted. So if I think about investing in say, equities for income, the volatility that you're exposed to associated with investing in income or investing in equities for income is something that should not be present for an investor investing in debt generating income. Our asset class, particularly in direct performing loans, isn't going to provide investors with significant upside participation. The underlying loan assets should provide for stability of capital, and it's a contractual obligation imposed on the borrower. So if I look at the traditional sort of ways in which investors have sort of thought about asset classes, the one on the left, it's a fairly traditional type of approach: cash, Australian bonds, international bonds, showing a risk and return process or available risk and return outcomes for investors. I think since launching MXT and MOT on the market, we've now been able to demonstrate to the market that there is actually a different asset class that perhaps delivers a different risk, return and volatility outcome. And it's pleasing when we look at MXT now that it's been listed on the exchange since October of 17, investors can now see what is the level of income that's being generated and what has been the stability of the capital of my investment. What has it traded like on the stock exchange? Has it delivered everything that I expected? And pleasingly, we've seen that now delivered with MXT in terms of lower level of volatility, but a return that's commensurate with the income and returns from other asset classes. MOT was our higher yielding fund that was launched in April of 19, designed to give investors participation rights in debt, but also where we're negotiating transactions directly with companies. If we see the ability to gain upside participation rights for our investors, then we believe that we should try and do that. And so MOT is designed to be the higher yielding fund and vehicle for investors, giving investors rights to participate in potential upside gains through negotiation of instruments like options or warrants, or taking an outright equity interest in a project or a company that we may have lent to. So these are the various vehicles that we operate now, and I put them up just simply to show people that at the end of it, we have a process here that allows investors to gain exposure from very high investment grade credit through sub-investment grade, but our funds also give investors the ability to participate through the capital structure. So when I think about the general market, people often make references to sub-investment grade loans or sub-investment grade debt as being junk. I guess what I would say is they fail to understand perhaps the benefits that are available under Australian corporate insolvency laws to a secured creditor. And so we believe that there's a range of things that you do as a lender to structure, to mitigate risk of downside loss, and we have appropriate mandates to deliver that risk and return outcome for our investors. And so these boxes are just simply the way in which an investor can gain access to a private market, have a clear understanding of what is their risk objective, what return are they seeking to achieve, and then what is the liquidity options that are available for them. And so through MXT and MOT being publicly listed on the exchange, we've effectively transformed investors' holdings that were previously in less liquid or illiquid asset classes, now giving investors a means to be able to trade those on the exchange on a daily basis. So if you think about when you lend money to somebody, you'll charge a higher price for the longer term. So if you lend for, say, 12 months, the credit margin might be a particular rate of return. As you increase the tenor, the risk to you as a lender is increasing. So if we're lending for, say, 3 or for 5 years, the credit return or the credit margin that is attached to that loan will increase, reflecting the longer term. Now all of a sudden investors are getting the benefit of that and being able to trade it on the exchange on a daily basis and receiving the income on a monthly basis. So our funds have been designed to give investors choice around what is the risk they're taking, what is the return objective, and how do they best manage liquidity in an illiquid asset class. So this is the historical performance of our various funds. You can see, again, from a more conservative option in our Diversified Australian Senior Loan Fund, delivering close to 5% there since its inception, delivering then up to the higher yielding fund, closer to 10%. And again, this recognises that it's not a homogenous market. When you lend to a company or you lend to a project, the risks you take as a lender need to be understood, and then you need to structure the appropriate controls to mitigate that risk of loss. So as a lender, if I think about the asset classes, going back to the asset classes, you sit there and say, equity will always be your most volatile, highest risk asset class that you're investing in. And yet we have a market that effectively buys equities for income with a view that that's their only alternative. And so what we've sought to do to bring to the market was a means to give investors more capital stability through debt, but giving them an attractive income. So capital stability combined with income, we believe is a great option for people that previously had limited choice. So if you go back to pre-October of 2017, an investor looking to allocate capital across their sort of more conservative part of their portfolio really had limited choice. It might have been a hybrid, might have been a bond, might have been a term deposit. Very limited ways in which you could get diversification. Now, as a result of MXT and MOT coming to the market, we've now seen a number of managers bring quality products to the market, giving investors choice. Now investors have got the choice to invest in Australian corporate debt, international bonds, domestic bonds, high-yielding European and US debt. But the important thing that I think is important is that investors really need to now dig into the asset class to really understand what is it, what are the underlying assets that are held in these vehicles, and what is the risk and the return that I'm receiving, and what is the likely liquidity of those assets. Because not all debt is the same. And so when I think about it, it's just very important for people to understand that when you originate transactions, you can originate a transaction in a very high investment grade quality corporate. The credit spreads that you get in that will be quite low. So if you go back to that particular chart that we showed at the start there, if you think about a range of investment grade corporates, the credit spreads on investment grade corporates will be quite low. As you move along the risk spectrum, the return, the fees, the margins and the like that are charged to borrowers as you move into sub-investment grade exposures start to reflect the increasing level of risk that you take. But as a lender, it's our responsibility to understand the companies we lend to structure the appropriate terms, the conditions, setting covenants, negotiating the right price for that risk to deliver the outcome for an investor. And it's our view that in credit, it makes a lot of sense to be very well diversified. But in terms of the options that are now available for investors when they think about investing in offshore credit, I think one of the things that people need to really do is the diligence around the underlying assets. And so there's a lot of discussion and debate in high yield markets and the like around the weakening in, say, US high yield markets around covenants and controls. As a lender in the Australian market, there are a range of protections that you have available to you to protect your risk from downside loss. And that's through appropriate covenants, appropriate controls, discipline around the way in which a company might be able to release or access its cash flows. So when I think about the world of sub-investment grade debt, and people say, oh, it's junk bonds if you're investing in sub-investment grade. And we lend to, say, a private equity sponsored company that we've provided funding to. In the Australian market, that company will be funded into an SPV, will hold security over the whole of the company. There'll be covenants that will require the debt to be amortised down and reduced over a period of time. There'll be appropriate controls to ensure that the company is generating sufficient cash flows to be able to service and repay its debt. And there'll be covenants that will be imposed to monitor the risk associated with any change in or increase in leverage. And as a lender, there's no distributions to equity. So there's no dividends in those structures. The cash flows that are generated from that company are used to service and repay your debt. So from a lender's perspective, it's not just simply about the credit rating, it's about the controls and the way in which you've mitigated the risk of loss through appropriate structures and negotiated facility documentation to control your risk of loss. And all of that comes down to our team undertaking a deep analysis around the companies that we lend to. So appropriate due diligence. So when I think about lending, say, to an operating company, there will be accounting and tax due diligence. There will be external legal advice that's provided. There's commercial due diligence to understand how the company might perform and interact in its industry, all designed to allow us to dig into the detail as to what are the key cash flow drivers of this business and what is its capacity to generate cash flows to be able to service and repay its debt over time. I think one of the things that's interesting, and I touched on it there before, is the theme, I guess, in terms of the Australian market and why we exist, I guess, as a lender. And I think there are two themes. One, the Australian market is very much a bank-dominated market. Australian companies tend to be unrated. They don't have external credit ratings. And as a result of that, their access to institutional capital is quite restricted. Most Australian companies are relying on banks for debt funding. The Australian corporate bond market is very immature in the context of a large institutional market. So if I think about the Australian corporate bond market, if you strip out governments and financial institutions, the Australian corporate bond market's around about 40 billion in outstandings. And you compare and contrast that to the on-balance sheet activities of the banks, and it's around about $1.2 trillion of corporate debt that sits on bank balance sheets. But the Australian corporates, given that they are unrated and that access to institutional bond markets is quite difficult, those borrowers become heavily reliant on the banks for funding. And yet the banks, as we all know, continue to face into increasing regulatory pressure, and they continue to have an increasing cost of funding pressure, which makes them not the natural holders of the corporate loan assets that they once were. And so it's our view that the market needs to develop and other alternative ways need to be provided to provide funding to Australian companies to grow. And so when I compare that, and I compare it now to the experience in offshore markets, if you think about the Australian market, it tends to be a bank-regulated, bank-dominated market. And so the credit risk that most companies are exposed to and what is held on bank balance sheets tends to be a credit risk of A to double B. And they are the kind of assets that sit on a bank balance sheet, loans to companies between those ratings. As they move further down the risk spectrum, in the Australian market context, that's almost like go and get equity. But in offshore markets, particularly the US high yield market, it tends to be a credit rating of double B to below triple C. And so now we have products on the ASX giving investors exposure now to the full risk spectrum, from high investment grade all the way through to almost defaulted securities. And so I think it's really important that investors understand what is the underlying nature of the assets that are held in these vehicles and what is the risk that the manager is taking to deliver the outcome and the income that I'm looking for, and what is the stability of capital. And so I think there are probably a number of features that I think are attractive in the Australian market compared to, say, an investor's exposure to, say, US high yield. And that's largely Australian corporate insolvencies. The Australian corporate insolvency laws are very favourable to secured creditors. We have protections that are not necessarily afforded in other jurisdictions that give you the rights and the powers to control your risk. So if I think about lending to a company, we will say that equity needs to be aligned and that equity needs to wear the risk of loss. And so if there's a deterioration in earnings, so we think about now the coronavirus and how that might flow through, obviously if there's a decline in earnings, that will be felt by equity. As a lender, I should have already made sure that there's sufficient equity buffer in the capital structure to sustain and support our position as a lender so that we're not at risk or exposed to the risk of loss. And so you could have a material decline in earnings. Yes, you as a shareholder are going to be impacted as a result of the capital value of the equities that you hold. Your income will then be impacted as earnings decline, impacting future distributions and dividends that are paid to shareholders. But as a lender, it's a contractual obligation that company then has to repay us our interest, to pay the fees and to pay the principal on maturity. So insolvency laws are very important in terms of ensuring your position is protected. Obviously, investing in Australian companies, floating rate exposures in Australian dollars avoids the risk to investors in relation to foreign currency movements. And equally, I've talked about the protections that are afforded to you through appropriate controls and covenants to protect your position as a lender. And what we've seen in offshore markets is that you have seen a reduction in the standards associated with the lending conditions that are applicable to some companies in offshore jurisdictions. So the other thing that I think is that there are a range of things that need to be called out in terms of the differences, one of which is the public nature of instruments that are held in funds versus private instruments. So if you think about investing in, say, MXT or MOT, the underlying loan assets that we hold are not subject to mark-to-market volatility. The largest risk that we expose an investor to is credit risk, the risk of loss in the event of a default. And so as a result of that, you're removing the volatility of the asset or the NAV because the underlying loan assets are held to maturity. And I'll point that out in that if we're lending, say, to a large company that's completing, say, a residential high-rise development, and we're completing that on a cost to complete on a construction basis, it would be very difficult to turn around and say to that borrower, oh, sorry, I need to sell your loan asset to create liquidity for my investors. So you lend, in the Australian market, you're lending for the term for which you're providing the funding. And so they're not traded, they're not screen traded loans, they're assets that are negotiated private, and they're held based on core fundamentals of the credit risk that you're exposed to, and we don't trade those assets. And so one of the features that is absent in the underlying loan assets that we hold in both MXT and MOT is the absence of mark-to-market volatility risk, because the underlying loan assets, the biggest risk is credit risk. And so one of the things that we've done in our particular funds to ensure that the market is informed and educated in relation to the risks that we expose investors to is a proper governance process around ensuring that there's an independent party that reviews and assesses, independent of ourselves, the risk of impairment or the risk of loss in portfolios that we hold and operate. I think the other thing that if I look at our vehicles, particularly MXT, we have tried to deliver to investors a vehicle that provides stability of capital, that is highly liquid, can be traded on the exchange, where investors can enter and exit without moving the price. We've tried to do it in a way that you've got exposure to a well-diversified spread of corporate debt. So when I think about MXT, the portfolio is now diversified across around about 140 individual positions. The individual exposure you have to any one individual borrower is around about 0.9%. So we've continued, as we've raised capital, sought to continue to lower investors' exposure to credit risk by further diversification of the portfolio and providing greater levels of capital stability as you're removing that risk of credit loss. But I think the other things that we've tried to do is give investors access to an institutional quality product on institutional terms. So often I think a lot of LICs and LITs have created problems in that they've been marketed to retail investors with a fee load that is it's more profitable for the manager to perhaps distribute a fund for retail investors, yet the institutional investors might get a better fee deal. What we've sought to do with MXT is that investors investing in MXT pay the same fees and costs associated with the very largest of an institutional investor. And so I think that was a unique feature that we brought to the market when we brought that particular product to the ASX. But the proof's in the pudding in terms of really what's happened in the last couple of weeks in terms of volatility. The underlying loan assets that we hold should provide for stability of capital. Not only are we looking for a highly liquid, tradable instrument on the exchange, giving people daily liquidity in a less liquid asset class. We want to pay income monthly, so investors have got the ability to get a predictable, known income on a regular basis. But we also want to preserve and protect their capital from fluctuations in the market. And so from our perspective, informing the market around the daily NAV, ensuring there's proper governance processes around the way in which those assets are valued and tested for impairment, can give investors confidence that when you're buying MXT or MOT, there's an appropriate governance structure around it to ensure that your interests are protected. And I think the thing that we saw was the absence of mark-to-market volatility risk flowing through our funds, the clear understanding in terms of investors' understanding around the risk and the defensive nature of loans. So if you've contracted to lend $1 to somebody, you'll receive the interest and fees associated with lending to that company, and the obligation is on the part of the borrower to repay you on the required date. There's no subjectivity, there's no variability. You invest in an equities LIC or an equities product, you're always going to have a degree of subjectivity as to the valuation of the underlying assets on a day-to-day basis. There's no subjectivity when you lend money to a company, and that should be then reflected in the carrying values of the portfolio. There's a range of things that we'll talk through in the Q&A session, and I think a number of these things are features that are relevant. The effect of low interest rates, so the underlying loan assets, for instance, that we hold in MXT, predominantly floating rate. Floating rate is a means to protect investors where interest rates might rise. So in a rising rate environment, if you're in a fixed rate bond fund, for instance, the capital value of that bond will be impacted. In a floating rate vehicle or a vehicle where most of the underlying assets are floating rate, obviously a decline in the base rate will impact investors' total returns. So obviously as the RBA cash rate flows through, that will lower the total return to investors. But what we're looking at is how we manage our portfolio to deliver better sources of income for investors. And those sources of income come from fee income, and they come from appropriately charging margins, credit margins based on the risk that you take. And so I would always say that the fee income that you're able to generate by charging a borrower an upfront fee is a far better source of income for investors than simply relying on the interest coupon that's available to you. The regulatory headwinds for the banks, that's just a continuing theme for our business. So as the banks continue to withdraw capital from certain sectors, we continue to see good opportunities to lend to companies. And so as a business at the moment, we sit in a position where we have around about $5.5 billion of assets under management. That's capital fully deployed. We run a pipeline of around about 2.7 billion of new transactions that we're looking at. Across our funds, we do between 100 to 150 million every month, just in terms of recycling and redeploying the capital of companies that have repaid us. So as a lender, it's our view that you lend for shorter periods of time. You want to provide benefits to your investors through shorter dated exposures, and those shorter dated exposures reduce investors' exposure to credit risk. Obviously, if I'm analysing and assessing the credit risk associated with a company that we're looking to lend to, I can have a far greater degree of confidence around the performance of that company in a shorter period of time than, say, over a 10-year period of time. By lending for shorter dated periods, you've reduced the market risk. So volatility of credit spreads is going to be a thing that will reduce the risk to investors. As a result of the churn of the portfolio, it gives you the ability to charge fees on a more regular basis, driving income for your investors. So all of our activities are designed to provide our investors with exposure to a well-diversified, well-structured, well-managed portfolio of credit assets, delivering stability of capital, but delivering attractive returns that are uncorrelated with other markets. And I would say, a large part of the ability to deliver income for investors through our asset classes is the skill set of the manager. If you're passive and you wait for a bank or another party to deliver an asset opportunity to you, or a bond or an equity, that you're going to receive the income and the outcome associated with what's been offered to you. If you're out there in the market looking for opportunities to drive return and deliver outperformance to your investors, you're going to be driving the fee negotiations. You're going to be looking to do things to mitigate the risk of downside loss through appropriate covenants and structures. And so from our perspective, we would always say you want to bring your investors closer to the point of origination, where the transaction is first entered into, because it's at that point where fees and charges that are applied to the borrower are greatest. And so as a result of our activities, we believe we bring our investors closer to that point of origination, where we think we can maximise income for investors through not only the interest coupons, but also through fee activities that are charged to borrowers. The impact of the coronavirus, I think we'll go through in a lot more detail through the Q&A section, but I think it just comes down to, again, fundamentally understanding where you sit in the capital structure. Obviously, there are going to be impacts through the broader economy as businesses are impacted, but again, that risk as a lender should be borne by equity. So as equity is your buffer for loss. So if I think about the asset class, equity is your asset class you're investing in for capital gains and growth in earnings. The debt part of the capital structure should be the lower risk part of the capital structure to protect your interests as an investor. So it's the part of the asset class, and in our market, you can certainly, if credit quality was to deteriorate and impact the value of equity, you can burn through a lot of equity before you as a lender have even lost $1. And then at that point in time, you've got a range of things that you can do to mitigate and control your risk of loss, take control of the company, that then may actually provide investors with upside participation as you pursue ongoing recovery actions and the like. So we can talk about that, but I think the main thing here is to understand that requires a degree of diligence around the way in which you assess and manage credit risk to avoid things like downside risks associated with coronavirus. It's actually interesting. I always think Don says it very well, avoiding dividend traps. For us, that's just avoiding situations where companies' equity value is deteriorating to a point where it might actually impact us as a lender. So in the same way, Don tries to deliver income, from stability of his investments and the equity positions that he holds. For us, the stability of the capital should already be protected from those substantial potential declines in equity value, delivering greater levels of stability to investors in relation to the underlying assets that we hold. So I'll leave it at that and look forward to the Q&A. Thank you.